Hi, my name is Darren Joseph from Tax. We're the team that seeks to demystify this sometimes confusing world of international tax and the privilege of having a deep conversation with Mark. Mark, can you please introduce yourself?
I'm Mark Morris. I'm based in Switzerland. I've been here for about 26 years. I've specialized in automatic exchange of information, which originally was the EU Commission's EU Savings Tax Directive. And that went on until about 2014, and they scrapped that and they adopted the OECD's FATCA made into CRS.
So can you share with us what it is you do professionally?
Primarily, I provide custodial services for trusts to hold underlying entities or partnerships or unincorporated funds. So what I do is I provide the administration services for the custodial. I don't do the actual custody. And later on, I'll explain what administration services for custodial is. And I'm an expert in CRS and CARF, and I certainly know the intricate differences between CARF and CRS. We'll get into that in a later question, okay? I've published over 600 articles on LinkedIn, and I'm still writing about 10 a week. And I don't see other people covering 99% of the topics on CRS that I cover.
Okay, thank you.
Let's stay with passive NFEs for a while. Can you comment on non-participating investment entities? Well, what are those and how is it relevant?
Yeah, that's not a bad question because it is related to passive NFEs. When somebody sets up an investment entity that's located in a non-participating jurisdiction, so if it's a trust, it's a trustee in a non-participating jurisdiction, or you've incorporated in a country that's non-participating, such as Vietnam or Cambodia or something like that. And then you've got a bank account anywhere that's participating, like Singapore, okay?
Yeah.
And the assets are, or some of the assets are professionally managed. Then it's an investment entity. So what the CRS did is they said, okay, if you're a non-participating investment entity, you're going to be deemed or regarded or treated as a passive NFE, and then we're going to look through you. You're going to be transparent. It doesn't matter where you are. And we're going to look through your parents. And even if your parent entities are financial institutions, you look through that. Normally FIs, if it's a holding entity, you don't look through. But for passive NFEs, you look through. So there'll be double reporting. One, the look through by the bank maintaining the financial assets, and again by the parent FI of the investment entity. But they don't do that with other types of FIs. So if a parent of an investment entity is a custodian institution, then the investment entity does not look through the custodian institution, even though the custodian institution is non-participating. And so why is that? Why do they only look through investment entities? Because if you try and look through a custodian institution or a bank or an insurance company, any other type of FI that's not a passive NFE or investment entity. Let's say the largest custodian institution in the world is Pershing, JP Morgan, okay? If you try and look through to the controlling persons and see who's reportable, well, there's thousands, millions of people that own that. So there's nobody at the threshold, even if the threshold is 5%.
Yeah.
In that case, then the controlling person is considered the senior management. So imagine saying, well, Jamie Dimon is a senior management and he's the reportable person. So they don't do that. Yeah, so it's only investment entities that they look through and treat as passive NFEs. And obviously they look through passive NFEs.
Okay, so what's the opportunity? What's the advantage? What's the issue there?
Well, if you're trying to set up a structure that won't be reported, then you've got to use another type of financial institution as the parent and not an investment entity. And it's pretty easy to convert investment entity into a custodian institution, okay? Because let's say a investment entity is a trust.
Yeah.
It's easy to say this trust is holding the assets for somebody else. That's a custodian institution. The only difference is, does that custodian institution earn custody fees? And there are 6 types of custody fees. And the one is just crazy. It doesn't make any sense. The weakness, okay, of a custodian institution fees is providing financial advice on assets that are held or has the potential to be held. So if they just say, this is the custodian institution, we suggest that you hold NVIDIA or Apple or Amazon, but you don't actually own it and you might never own it. But guess what? For charging those fees, that entity providing this advice is a custodian institution, as long as 20% of its total fees are custody fees. And of course, 20% will be custody.
Therefore, there's no reporting required.
Just with a tweak, it's easy to have a structure that's not reportable.
Okay, understood.